I cannot believe I'm saying this, but the stock market, as you can see, is back at all-time highs. There's 3 important lessons to take from this. But first, let's just run through what's going on. The S&P 500, as you can see on screen, is back at an all-time high. It is up 4% year to date, and it's currently sitting at its record high, which is insane to think about with literally World War III going on as we speak. From the perspective of a UK investor investing into the S&P 500 using something like VUAG, we're also up about 4% for the year. And similarly, it's once again at all-time highs, which is genuinely mental. I've just been through my own investment portfolio and updated my spreadsheet, and I'm currently sitting at an all-time high in my own portfolio at £188,000. If I scroll down here, you can see it's absolutely insane. And when I done my recent portfolio update at the end of April, you can see I was actually up at that point, but I mean, back in March, I'd lost about 10 grand for the month on paper. Of course, I didn't sell anything. In April, as the war was still going on, the market bounced back and I essentially made back all of those losses on paper from March. And now, today, as of the 23rd of April, updating this, I'm actually up £5,000 for the year. It's genuinely mental, and it really shows why you always need to stay invested. Not so much on YouTube, but on my other social media platforms, I was getting a lot of comments and DMs from people essentially nervous to invest, even potentially selling because of the ongoing war. Yet, I mean, look at the performance of the market. That is the S&P. Coming onto the global stock market, which of course is how I invest myself. Once again, we're literally at all-time highs. This is VWRP, the most popular or the largest low-cost global ETF. And you can see once again, year to date, in terms of GBP, we are up, nearly 6%. And all that red there was very short-lived. I don't want to blow my own trumpet too much, but funnily enough, bizarrely, this on screen actually came up on my Instagram the other day. This was a post that I made back in, at the bottom here, you can see November 2020, because 2020 was my 3rd year of investing, and it was when I knew it was impossible to time the market. Back then, for a bit of context, I actually was still investing monthly, but I held off investing more money. In my mind, it made sense. There's literally a global pandemic. There's billions of people locked down. There's millions of people dying. So surely the market was going to fall. What happened to the market? It actually did fall, of course, in the short term. I've got it here. There was actually the steepest or the biggest, sharpest decline in stock market history. I've got here the FTSE World and the S&P 500. Both of them were down quite a lot within the space of a month, 20% or so. And then there was the quickest recovery from that magnitude of crash. And really, it was at that point where I just realized I lived through this. I was investing. I only had probably about £10,000 invested back then. So it's a lot different now to my 6-figure portfolio. But mentally, it just didn't make any sense to me. And I've never held off investing again, if that makes sense. Because back at this point, I just thought I was still investing at that time about probably £200 a month. It was soon after I started my grad scheme in London. So I was still investing automatically, but I had a bit of extra money saved up. I wasn't sure what to do with it. I was going to actually go, I think, traveling or go on holiday with it. But then the world was locked down and I purposely held off investing it. And boy, how wrong was I? I essentially missed out on the quickest and one of the best ever recoveries. And it's almost happened again, this back to the FTSE World, this very sort of nerve-wracking or so crash back here. World War III is literally going on, essentially, and there's also been multiple world wars going on, and the market is once again at all-time highs. This is going to sound a little bit insensitive, but the stock market just doesn't care. It doesn't care. Even in my relatively short 9-year investing career, if you want to call it that, that was just after Brexit. There was then, as I mentioned, a global pandemic. There was record high modern inflation, record high modern interest rates. There's been a cost of living crisis that is still going on, has been ongoing for a number of years. There's actually been other wars going on in Europe, in the Middle East, and now there's literally, essentially a world war, and the stock market just doesn't care. It just doesn't care, which is why, as we're going to go on to now, these are the 3 most important lessons to take from all of that. And actually, just quickly coming back to this, this tweet that I posted then on Instagram at the end of 2020, I'm actually quite happy with this. Someone's going to blow my trumpet one more time. But let's get into the 3 most important lessons. And actually, each of these lessons has sort of sub-lessons and other learnings in there as well. So hopefully you'll either learn something new from it, or it'll consolidate and reinforce what you're already doing with your own investments. A 10-second tangent, but if you need a hand with your own investment portfolio, click the first link in the description. We're kicking off Monday, so be quick and I'd love to help you out. Anyway, back to the video. The first one, and I'll keep VWRP up on screen. You can look at the lovely historical return over the last year. Actually, this is actually a good point to show. The first one is market timing. And you've heard it before if you watch this channel and follow other finance YouTubers and people who post content, but just stop trying to time the market. Time in the market always beats time in the market. I learned that back in 2020. Buying the dip as well. It sounds cool, and if you can time it perfectly, it's great, but it just doesn't work. The simplest thing is just to invest whatever you can afford to each month, regardless of what's going on. The perfect time doesn't exist. This time is not different. And the whole thing really, I guess my thought process with this is, I have no idea what will happen. And to be honest with you, no one does. No bank, no economist, no big investor, no one knows, which is why just staying invested and carry on investing business as usual isn't just simpler, but you can see over the sort of longer term, it just wins and grows your money. Those big crashes look like little blips, and in 10, 20 years, they're going to be almost non-existent. If I actually look at the S&P 500 over its maximum period here, I guess they still do register the big ones. COVID, you obviously got the financial crash. I mean, the financial crash hardly even registers here. But yeah, I guess the good sort of quote to remember here, not just time in the market beats time in the market, but if in doubt, zoom out. And to be honest with you, whether you buy or invest today at, the market being up 2% or down 2%, it really will be irrelevant, most likely, in 20 years. So stop waiting, start investing. Another good slogan that some random bloke come up with, but time in the market always wins. And this really goes for stopping your regular investments. I would say don't do that, because it's just impossible to time the market. And also keeping excess cash on the side like I did back in 2020. If I had invested it straight away, I would essentially have much more money now. So just any cash you don't need for the long term, we're talking 10 plus years, just get it invested. And the way I try to think of it psychologically as well is, just say I invest today, if the market goes up or down, it's a win-win. If the market goes up like it has right now, as we sit at all-time highs, that's great because I'm wealthier on paper. But if the market goes down, then it's also great because I can invest each month at lower prices. The second lesson, in my opinion, is having the right setup. And I think it's actually about taking a step back and looking at the most important things. What are they? Your asset allocation, your tax efficiency, and your fees. I think your setup is the most important thing. So let's go through them one by one. I think the second and third one are, of course, quite self-explanatory. Tax efficiency, you essentially in 99% of cases always want to use a pension, whether a workplace pension or a SIP, and a stocks and shares ISA before using other types of investment accounts. There's different but massive tax efficiencies in pensions and ISAs. Secondly, low fees. You of course probably know this already, but the lower the fees you can pay, whether they're platform fees, trading fees, regular investing fees, the more money you're keeping in your pocket and you're compounding over the long term. They are two things that are directly in your control, and the more you can reduce your fees and your sort of current or future tax bill, the more money you have compounding in your own pocket. The third thing, particularly probably more overlooked, is your asset allocation. And essentially that comes back to your time horizon and your risk tolerance. I think that a lot of people are either overly confident or too pessimistic. And it can be hard to find the perfect asset allocation for you. And it might take a bit of trial and error. But to give a couple of examples, if this little crash or dip of a few percent has really stressed you out, you're probably investing too aggressively. If you're 100% in the stock market, even using a 100% global ETF, you might want to add bonds into your portfolio. Your risk tolerance might not be high as you think, because the most important thing you want to avoid when you're investing is panic selling. Panic selling will just destroy your wealth more than a crash will. So that's one example. Another example, though, is where people who are maybe younger in their 20s or 30s are potentially overly cautious. Particularly that money's in the workplace pension, for example. You can't access that for 20, 30 plus years. So you actually probably want to be in the most aggressive or a more aggressive portfolio, a more aggressive fund, because you have much, much more time. You have decades to ride out the ups and downs. So your risk tolerance and your time horizon really feed into what mix of stocks and bonds you should actually invest into. Then to sort of tie that together, it then comes to what we should actually invest into, the actual specific stock fund and the bond fund. But I think the asset allocation question is actually the much more important one. When it then comes, though, to choosing what to actually invest into, I personally just stick to global funds. I mainly have global index funds and ETFs. If I do add bonds in at some point in the future, it probably won't be for a couple of decades, but I think that I would just use a global bond fund, to be honest with you. A really good quote, I'm trying to smash out a few. I feel like I'm on a podcast when I reel out quotes every 5 minutes that sound good. But a good quote to remember here is diversification is the only free lunch in investing. It always feels great if you pick a random stock and it goes up loads, but unfortunately, it's hard to distinguish what is luck and what is skill. So I think being diversified, or at least keeping most of your money in low-cost diversified index funds, really is the best way to invest for most people. And then once you have your setup correct, your asset allocation and the specific funds, your tax efficiency, and hopefully your low-fee strategy, then all you need to do is just feed the machine and invest regularly what you can afford to every month. And of course, don't time the market. The final lesson, and probably the hardest one, is behavior, human psychology, and it's falling into those behavioral pitfalls, being your own worst enemy, because that is actually what will destroy your investment portfolio more than any crash will. So what are some examples? Panic selling, which is a big one. If the market, as I mentioned, has fell and you're really stressed, you've probably got to rethink your asset allocation. But panic selling, Pete Matthews actually has a really good quote on this in terms of long-term investing, and it is that uncertainty is the permanent condition in markets. It's always uncertain. No one knows what's coming. But over time, once again, as you can see on screen, the markets do just go up over the long term. That's how it happens, and it's really driven by human innovation and productivity over time. But you really want to avoid panic selling. That is probably the biggest thing that will destroy your portfolio more than any crash. Other psychological or behavioral pitfalls: over trading when you don't need to, chopping and changing your investment approach, chasing past performance, chasing what's hot, chasing what's shiny. The best investors really set up their system in the best way possible, as we touched on in the previous point. They stay calm, and then they just stick to their long-term plan without getting sucked into all of this, doom and gloom or euphoria. It can go both ways. Right now it is a bit doom and gloomy, but once again, the stock market just doesn't care. It's at all-time highs. So I think if you can avoid a lot of those behavioral traps, the thing is, of course, it's good to stay well-informed and stay up to date with what's going on in the world, but just don't let that influence your investment decisions, essentially. And if you are changing something based on emotion rather than thinking through what is the long-term plan, is this in line with my long-term plan, then it's probably not a good decision. Another point worth making here as well is a lot of people, of course, especially if you're watching this channel and you made it this far in this video, you're probably interested in investing. You probably like researching stocks, researching new sectors, and that's completely fine. I would just say, once again, just keep those other investments as satellites in your portfolio, whether it's 20% or so. I probably wouldn't say go much bigger than that, but keep the bulk of your portfolio in low cost index funds. Don't time the market and feed the machine. And you want to try and pick stocks, time the market, do that with a much smaller part of your portfolio. And to be honest with you, a bit of a tangent, but what's quite funny is, I've actually heard from other people who have been investing to sort of a similar time as me. I'm nearly at 10 years. Other people have been investing for 5, 10, 15 years. And it always starts out, and this was the exact same with me, you have some individual stocks, they make up most of your portfolio. Then you start switching into funds, but you have loads of different funds, all overlapping, all in different sectors. And then slowly over time, you have more and more of your money in just low cost global index funds. And before we finish up here, going back to my investment portfolio dashboard, you can see if I scroll down, investment by type, 90% of my money is in index funds and ETFs. The specific ones are here on the left. But I go to my stock market portfolio, 99% of my stock, 99.7% of my stock market investments are all in low cost global index funds and ETFs. And that is essentially how I invest my money. I don't want to time things. I have no idea what's going to happen. So all I'm going to do is just feed the machine, keep investing, and then hopefully over my time horizon of 20, 30, 40 years of my life, I get some good returns. But I know that's all out of my control. So all I'm going to do is feed the machine, keep investing, and then hopefully time and compound interest will take care of the rest. That wraps up this video. If you have any thoughts at all on any of this, please leave them in the comments down below. I mean, if you are changing your investment approach because you want less US exposure or you're adding some more bonds in, once again, please let me know. But I appreciate you watching. I'll keep the videos coming. Subscribe for more, and I'll see you in the next one. And if you do need a hand with investing, check the first link in the description. Or if you want to continue going down the investing rabbit hole, click the link on screen. I will link my latest investment portfolio update. I go through this spreadsheet, everything I invest into, what I've been investing into so far this year, and more. I'll link that video on screen. So I'll see you in there.